Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss factor momentum and how to allocate among trading strategies.
Hello everyone, my name is Radovan Vojtko, I'm CEO of Quantpedia. Today I would like to discuss how to build strategy that's managing how we allocate our portfolio among multiple trading systems or trading strategies. So when you are somebody who is just starting with the quantitative analysis and algorithmic trading, you are maybe looking for the first algorithmic strategy or trading strategy. When you are experienced quant, usually there is another problem. You will already have so much strategies and so much systems that you are looking for a way how to manage those systems and how to allocate your portfolio or your money between those systems. And that's the question how we can do it. So the trading strategy performance usually change in the cycles, because the performance of the trading strategies usually depends on the underlying macroeconomic situation. So it depends on the inflation, it depends on whether we are in a bull market or bear market, what are the interest rates, if they are going up or down, etc. A few months ago we did the analysis. We analyzed what are the historical market cycles and how the different factors perform during the different cycles. Factors that we used in these analyses were not exactly the trading strategies. Those we used simple assets like US equities, US treasuries, commodities, different equity sectors, world equities. We used also some simple factors like small cap versus large cap equities and trend, for example. So simple trend following strategy. What I just want to show you in this example, as I mentioned, the strategies and assets perform very differently during different phases of the market. When we have a bull market, usually the equities outperform. Also the diversified strategy can outperform, but usually the commodities are not performing well. On the other hand, when we have a bear market, treasuries and US bonds outperform. Also the trend strategy outperform. On the other hand, US equities are not performing well. It is the same during the other cycles, so during the high inflation, during the low inflation, etc., etc. Now the question is how we should manage our portfolio during these different cycles. The same variation as is in assets is also in equity factors, only factor strategies or trading strategies. There is an interesting paper written by David Blitz. It's called the Quant Cycle. The David Blitz checked what is the performance of various well-designed factors like value, investment, betting against beta, etc. on a period between 1963 and 2020. In this picture here we have how the various factors performed during the expansion. So we can see that during the expansion the best performing factor is the momentum and the betting against the beta, so the blue bars. During the recession the best performing factor are the quality and investment factors. During the inflationary period it changes. So during the inflationary period the best performing factor is the momentum. It can be short-term idiosyncratic or classical, the winners versus the losers of momentum, and the best performing factor during the normal times, so during the low inflation, are the low volatility and betting against the beta. So as we can see, the performance of factors and trading strategies and all of the smart beta strategies is really different during the different periods. How we would allocate between those strategies. I can point you to an article called How Do Investment Strategies Perform After the Publication, in which we reviewed multiple academic papers and we check how we should allocate the money among the multiple different strategies. One of the most used idea is called factor timing, sometimes called factor momentum. What does it mean? We take our universe of strategies. It can be strategies that we found out, or it can be strategies that are extracted from academic research or our own original strategies, and we check their performance over some period. It can be either 1 year, 2 year, 5 year period, and we sort those strategies and we select those that are best performing, and we invest into those best performing, and we then after a month or after a quarter we do the sorting once again, and once again we select the best performing strategies. This idea is called factor timing or factor momentum. The chart that I'm currently showing to you is showing that the best performing sorting period is 2 years, but also 5 year, 1 year, 2 year period is fine. In each case we outperform the portfolio that will invest into all of the strategies that we have on average, so that's the dotted line, and it also outperforms the benchmark, which is the S&P 500 in this case. So that's the factor momentum. I will show you another idea or another way how we can take a look on factor momentum. So there is another paper written by Sakichi, Fiberg, Metko and Zaremba. It's a recent paper from January 2023. This paper checks what is the relationship between factor momentum and price momentum, because in a lot of the time some of the researchers expect the factor momentum, so the momentum based on the strategies. When we sort the strategies based on the performance and select the best, is just the price momentum. We are not sorting based on the performance of the strategies, but we are just selecting the best performing stocks that are luckily bought by the underlying strategies. Question is what leads what? So do the price momentum leads factor momentum or factor momentum lead the price momentum? What is the strategy feedback Metko and Zaneba paper showing us is that there really is factor momentum. So yeah, stock price momentum explains the factor momentum, so that's the true. But on the other hand, there is also the factor momentum, especially when we have the strategies that are not using the same asset class. So there is also the independent factor momentum. There is also another paper, deeper look into factor momentum, re-examination of factor momentum, how strong it is. In this case, the paper is reviewing 20 factor strategies. They are checking how the factor momentum works, and what they found out is the factor momentum is mostly driven by 6 factor strategies. In other cases, the rate of continuation of the remaining factors is weak. Even when we use the factor momentum and we select the best performing strategies, all of the performance would be coming only from the subset of the best performing strategy, or the subset of the strategies. When we select those that are most susceptible or most sensitive to the momentum, we can see that we can outperform if we use the factor momentum only on the whole universe. That's also the idea, how we can improve the selection of the underlying strategies, or how we can select the best performing strategies out of the universe of the strategies that we have. I would like to finish at this point. All of the articles are in the description of this video. I really recommend to review underlying academic papers because they are really good, especially Quant Cycle article written by Blitz, but also the other articles are very good. Thank you for your attention, and I hope that you join me in the next video.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.